Hello, welcome to this trade management mini session on candlestick patterns. This is going to be a first in a series where we look at a different candlestick pattern in each session. Today it is hammer time. We're going to look at what a hammer is, how it's created, and how a trader might use this to make a more informed decision in the context of looking at a bigger trend. My name is Barbara Armstrong. I'm a coach with Charles Schwab and delighted that you are joining us for this short session. Just know before we get into it that everything that we discuss here is for general information purposes only, none of it to be construed as a recommendation. We will look at a couple of examples on the paper money software application on the thinkorswim desktop platform. So without further ado, let's start talking about hammers. And the first question that you might ask is, how is this hammer pattern created? And that's a good question. And so what happens is we have a stock that say opens here for the day, and then the sellers come in and they drive the price down. And at some point the buyers say, hey, enough is enough, and they come in and they drive the price back up, maybe up even higher than where it opened, and then it comes down and it ends up closing here for the day. Now, does the candle pattern have to be created in this order? No. It might have opened here and then gone up initially, and then the sellers came in and took it down, and then the buyers came in, and then the sellers came in, and then, but at the end of the day, it closed here. And so, the high, the low, the open, and the close are the same. It's just how it was created. And so what are some things to watch for that are identifiers, if you will, when we look at a hammer pattern? Well, one is that the body of the candle is small. So we have a small body on this candle, and the tail or the wick is at least 2 times. So it's long, the length of the body of the candle. And so, we have a situation where it opened and at some point the sellers took the price down, and then the buyers came in and drove the price back up. It is considered to be a bullish win for that day because the buyers were in control for this day or this week or this month. I'm referring to this candle as a candle created in one day. But it's important that in spite of the fact that this is a bullish win for that day, we don't want to look at it in isolation. And by that, I mean that we want to look at this hammer in the context of the greater trend that is appearing on the charts. Okay, so that is our hammer and how it's created, and here's a little bit of how we want to look at it. Now let's go out and look at a couple of charts so that we can see these candle patterns happening in the wild, so to speak. So, we have Cisco, which has been uptrending. We can see that by the longer term line here, the 100-day line. And we have this period of consolidation happening. And then we get this candle pattern where we have small body, long wick. And we have another hammer actually happening here. Sorry, let me just come over here. And so how might a trader interpret this? Well, they might say, hey, what I'm seeing is that these hammers might be a confirmation that this support level is holding. And in fact, that support level did hold, and then the stock continued to go up. And then we see another hammer pattern happening here and another hammer happening here. And again, we've, hit a new high on this stock, and then it kind of pulled back and is consolidating. And might a trader look at this again as perhaps possible confirmation that this new support level is holding? And so hammer patterns, can be a bullish sign. They can be confirmation of a support level. But again, this is the beginning in a series. I hope that you'll enjoy all of it. So take care and have a really awesome day. Bye for now.